This is Millennial Money Mindset. If you want the fruits, you need the roots. Thanks so much for joining us. If you're new to this channel, this is for anyone who wants to save money in their pocket, time in their day, and joy in their life. So it's about helping you make better decisions with your money. Today, 7 ways to reduce your risk when investing. So this is super important. This is how to essentially reduce your stress and worry. You're going to actually save time in your day by trying to time the market, and also save money in your pocket. So, we're going to get right into it. So stay right to the end because we're going to give away super amounts of value. So if you're new to this channel, please like, please subscribe, and please tell a friend about Millennial Money Mindset. If you want the fruit, you need the roots. I've got a presentation, so I'm going to just quickly share this with you. So it's all about reducing risk. So my name is Neil Doig. I'm the founder of Money Tips, Tax, Investment, Property, Pension, Savings. We are different. We educate, inspire, and empower you to make your own investing decisions. So if you're also new, we give away a gift. Anyone who watches this today, just send me yes in the comments, or you can also send me an email, neildoig@moneytips.co.uk, and I'll send you a free training course, how to automate your savings to give you more me time. So real quickly about myself. So I started off in the shipping industry, moving giant tankers around the world, moved to gas trading, buying and selling millions of pounds worth of gas each day. So gas is if you turn on your cooker, and that's to heat your food, or if you turn on the boiler to heat your home, that's gas. I used to buy and sell that on a trading floor, kind of 8 screens around me, 12-hour days, kind of wondering why I was doing this. And I got that decision made for me as I got made redundant, and it gave me an opportunity to actually, what do I want to do with myself? So I looked at my strengths, looked at where the demand and what I enjoyed talking about. I was making more money from my investing and my trading than I was in my bonuses. So I thought actually this is a good way to how I could help people out. So I went and became a financial advisor, did all my qualifications, did all your kind of practical exam, we did all my practical exams, and had a portfolio of clients. And then I kind of had an epiphany. I didn't really feel comfortable helping rich people get richer, having to kind of hide money in an offshore bank account or bonds, offshore bonds, to try and save tax. So created my company called Money Tips, and we're different. We educate, inspire, and empower you to make your own decisions with money. And by doing that, we can save you thousands of pounds from expensive advice fees. So let's talk about risk. So why should you reduce risk? So you're like saying, maybe you're saying, Neil, risk and reward are related. Yes and no. So it's a bit of a paradox. So you want to reduce as much risk as possible when you're investing. You want to take anything you can reduce. That's better. I think of it like a car journey. So if you're getting into a car, you put on a seatbelt because that's going to reduce your risk of, if you crash, of actually causing real damage to yourself or even killing yourself if you're in a car. So you want to reduce your risk. It's a bit like putting that seatbelt on is going to reduce the risk. It's not going to slow you down anymore, but it's simply by doing that 2-second thing, by putting on a seatbelt, that's going to essentially reduce your risk. And you can do the same things with investing, doing real simple things, following simple principles and following simple processes is going to reduce your risk massively. So you can reduce your risk by 60% by doing one single thing, and that's not buying one single company. So I see people saying, Neil, what stock should I be buying? What single stock should I be buying? Should I be buying this company or that company? So don't buy one company. Today, it's never been easy to buy a basket of goods, a basket of companies. This might be tracking the market. This might be funds. This might be what they call ETFs, exchange traded funds. There's so many different ways to do it, but essentially you don't want to be buying one single company because that's essentially you're going to have company risk, and you can easily take away that company risk. So you want to take more risks. Then also, when we say you don't want to take kind of additional risks, you can actually increase the amount of risks you're taking. So this is by investing in companies that are solving meaningful problems. This is going to actually mean that you're going to take more risk than keeping your money in cash, for instance. So imagine you've got 2 friends. One, you just want to lend them money. You want to lend them £100, and the likelihood of getting that £100 back if they've got a steady, secure job is probably quite high. Maybe you've got another friend who wants them to invest in their company, to become an owner, and pay £100. They're just a small startup. They're not actually making any profits at the moment. To do that and get your £100 back, that's taking a lot of risk. So you've got 2 options there. Either you're lending money to your friend or you're buying that friend's company, a share of that company. So they're very two different ways. But on the flip side, if your friend's company is, say, Facebook, whenever that was 10 years ago, and that was your friend was Mark Zuckerberg, and now that £100 that you invested in that company is now worth millions, then that risk is worth taking that £100. You might have just gone out and spent that £100, but by buying that company, that share of that business for Facebook, who wanted to expand their business or wanted to get on new staff or wanted to take on kind of more projects, etc. That's going to, by investing in businesses, these are actually that solving problems. These are going, this risk is actually going to kind of give you more reward. So risk management is one of the most important skills you can learn when investing or trading. And that's what we're going to cover today. So it's all about risk. So it's all risky. So living your life is risky. Just walking down the street is risky. Using that car example, just get into the car and driving down the road and facing other cars, that is risky. There's a chance of things not going to plan. And this can all be risky. So life is risky. You won't get out alive. So everyone is not going to live forever. So there's always risk involved. So if you think investing is risky, then wait until you find out how I'm not understanding how to invest. So the thing is, to reduce your risk is actually learning how to invest. So if you want to reduce your risk, you can simply pick up a book. I've got some great examples of some books just by picking up a book and learn how to risk. So Random Walk Down Wall Street is a really good book, or Smarter Investing by Tim Hale is a good book, or alternatively, you've got Intelligent Investor is another good book. All these good books teach you about how the stock market works or how to invest. If you want the ultimate investing book, Millennial Money Mindset, if you want the fruits, you need the roots. I wrote that myself. And it was shortlisted by the Financial Times in 2018. Essentially, it's the ultimate investing guide. I've kind of summarized loads of different points, and you can get that on Amazon for just £10. So coming back to risk, it's all risky. So getting married is risky. Going into business is risky. So life is risky. So people I see all the time say, Neil, I don't want to invest. I want to keep all my money in cash. I don't want to invest into businesses. I don't want to invest. I don't want to lend my money to governments or companies because I don't want to kind of lose that money. I don't want to lose my hard-earned money. But simply by just keeping your money in cash is also risky. And we're going to go why that is risky in essentially the next step. So essentially, why is it risky? So it's all risky, but so let's go into why. What is risk? So the two main things of risk is inflation and volatility. So using that example of having his money all in cash, it's that cash is going to be eroded by inflation. So if that person's got money in the bank and they're getting 0.1% in interest rates, where the bank gives you an interest on that money, and inflation is at 2, 3, 4, even 5% now, you're going to be losing money over the long term. So two types of investment is volatility risk, which is ups and downs of the market, how far up and down the market will go, and also inflation risk. So inflation is the spending power in your back pocket. It's things getting more expensive. So if you notice, if you go down to the shop, say a loaf of bread was £1 today, maybe last year it was 95p, and maybe the year before that it was 90p. So things over time get more expensive, and that's just the way business works, and that's just the way that things get more expensive over time. And the way to mitigate that is to invest or to have money in assets. So living, breathing companies, things like the roof over your head. If you invest in real estate, housing, property, that's a good way to reduce your risk. Or other things like commodities. So commodities are things like oil and wheat and metals like gold and silver and copper. So all these things also rise at the same, tends to rise with inflation. So risk is measured by the amount of volatility. That is the difference between actual reserve returns and the average expected return. So how much you're expected to get back, how volatile is that market. So things like cryptocurrency, that's really volatile. So if you've noticed the big reductions recently, that over 2-3 months, it's been quite volatile. If you're new to that market, you might be thinking, wow, that's really volatile and that's too volatile for me. If you've been in the cryptocurrency game for quite a while, like myself, I've been investing in cryptocurrency since 2000, probably 17, 18. when I first started in cryptocurrency, and it's been hugely volatile, and it's been a fun ride along the way. But if that's too much for you, then there are other kind of less risky assets, less kind of ups and downs, less bumpy along the road of investing. So you might be invested in kind of the FTSE 100, which is kind of the 100 biggest stocks, or you might invest in bonds, or you can have some money in cash or some money in property. It's all about diversifying your portfolio, and that's going to reduce your risk by having a diverse portfolio. So standard deviation is measured by how much return on investment is gained from the expected normal or average returns. So essentially what that means is how big the ups and downs are. And that is what is risk. So risk is essentially the possibility of you losing money you invested. So if you have £100, like you said, you lend that money to a friend, you expect that back, to pay that back. You can invest in businesses, depending on different businesses are different on the risk scale. So we said that if your mate's just got a startup business, that's going to be super risky. If you're putting money into a company that's providing food or providing, say, toothpaste, for instance, then even in the bad times, people still need food, people still need toothpaste, people still need medicine. So if you're investing in these companies, essentially there's always going to be a demand for these products. You can buy these companies. So it depends on the company, depends on what asset class you're invested in. And also, even if you're keeping your money in cash, that's going to be eroded by inflation. So 7 ways to reduce your risk. So 7 ways to reduce your risk. So don't buy one company, as we said. So you can reduce your counterparty risk by not buying one company. Buy a basket of goods, track the market. If you're starting out, don't try and beat the market. Just don't get beaten by the market. You can track the market, and it follows the ups and downs of the market. And over long term, you can track it back to 17th century. It's going to outperform. It's going to rise in time. So if you see, like I've got a graph in my book, Millennial Money Mindset, you can go all the way back to the 17th century, and essentially the stock market will rise over time. So number 2, that's number 1. Don't buy one company. Number 2 is don't leverage your trade. So what does leverage mean? So essentially, it's leveraging your trades when you're borrowing money to invest. So if you buy a house, for instance, for £100,000, and you put down a £20,000 deposit, and you use 80% or £80,000 of the bank's money, you get a mortgage for £80,000. That's leveraging. So you've got £20,000, you're borrowing £80,000 from the bank to buy that house, which is £100,000, and that's called leverage. Think of it like a lever. You're levering that like a boulder. You're using a lever, like a lever, to push more than you could do normally. So rather, you couldn't afford the £100,000 house. You've only got £20,000, but by leveraging that bank's money, using other people's money, you are essentially leveraging. You're getting more than you're putting in, and which is fine on property. Because it's a solid asset, it's going to be there. But if you're using that to speculate on companies that own a startup, this is where it gets dangerous. So borrowing money to invest it becomes dangerous. I would definitely say don't do that, especially if you want to reduce your risk. So number 2 is think long term. So think long term. So don't think days, think decades. Think, where is this market going in 5 years' time, 10 years' time? So you should be investing into the stock market if you're thinking less than 5 years. So if you've got money that you can afford to invest over 5 years, then you can put it into the stock market. So think decades, not days. Like we said, you can track the stock market performance all the way back to the 17th century. And essentially you can see that over time, the market moves up. So that's number 3. Number 4, look at the evidence. So there's so much evidence today, so many studies, so much facts that you can actually track. So there's been decades of research and experience. So look what's working. So see what's been tried and tested and what works. There's so many things that don't work. So look at principles and fundamentals. What is working? So in my book, Millennial Money Mindset, I give you a formula, a 5-step method to money mindset. So your 5-step method to money mindset, you can pick that up in the book. And essentially it's like a recipe. You can essentially look at the evidence that's worked over decades. And essentially you can copy the formula. Think of it like a recipe in that when you're cooking. Essentially you're going to be, rather than making a whole mess, just putting things at different times, you can follow it step by step, and you can actually have a successful strategy. The next one is diversify. We talked briefly about diversification. So we talked about bonds, we talked about companies in the stock market. We talk about property. So having a diverse portfolio is going to reduce your risk. So why is that? So each asset class has different strengths and different weaknesses. And depending on these, they essentially think of it like a team. They come together and they create something better than individual parts. So it's like a team working together of your portfolio. And essentially it's going to reduce your stress in when the markets crash. Other asset classes do well when the market crashes. So like gold, for instance, does well in bad times, whereas in good times, things like asset classes like stocks do really well. So having a diverse portfolio is going to reduce your stress and worry, and essentially going to create natural synergies that are going to create something better than individual parts. The next one is pound cost average. What is pound cost averaging? Essentially, it's investing every month consistently. So it doesn't matter about the ups and downs of the market. You invest the same amount of money of what you can afford every month, and essentially overall. So in the good times, you invest. In the bad times, you invest. And in the good time, you're going to be buying less because the market's higher. In the bad times, you're going to be buying more because the market's less. And overall, you're going to get much better results. And then finally, how to reduce your risk. Get money coaching. So get someone who's been there and done that before. So like any skill, you're going to learn so much quicker if you learn from someone who's done that before, who's had experience, who's had education, who's essentially got a tried and tested method. So you can use my method. I've got 4 levels of service, which I'm going to go into next. But just to summarize those 7 ways to reduce your risk. So don't buy one company, buy a basket of companies. So either that's a tracker, index tracker, or funds or ETFs. So that's number 1. Don't leverage your trade. So don't borrow money to invest or speculate. That's pretty dangerous. Number 3, think long-term, decades, not days. Number 4, look at the evidence. There's so much research out there at the moment. Buy a book and actually start studying yourself. I've got so many references in the back that like literally hundreds of books that I've sourced from. Like I think that was like 30 pages or something like that of kind of books that I've referenced that essentially I've used their data or I've used their studies. So the next one is diversify between asset classes. I've got a card game called Football Formation Asset Allocation, and it teaches you how to invest around a football team. So you can use that to diversify your portfolio. It's a game that teaches you how to invest. A card game. It's the world's first investing trading card game. Next one is pound cost averaging. So invest every month consistently, and over time you'll do better than trying to beat the market. And then number 7, get money coaching. So find someone who's done it before and use their strategy, use their method, and it's going to save you so much time, it's going to save you so much energy, and it's going to save you money from making costly errors and kind of falling down pitfalls. So my company's Money Tips, we have 4 levels of service. So we have bronze, silver, gold, platinum. So my platinum is a one-to-one coaching where we work together one-to-one, and I give you everything I know. Essentially, we have a number of different sessions. We have laser coaching where if you've got a question, you can just give me a call and leave a message and I'll get back to you. We build your own football formation. We check your pension, check your insurance. We also look at your risk profile, your psychology profile. We do a personality test. There's a number of bonuses as well. Learn how to trade, learn how to invest, learn how to start a side hustle. So that's the platinum service. That's $797. Gold package is a group coaching. So we're opening up the group package again, and it's a discount price. We meet every month. There's a video book, 12 video books. We're going to have a day accelerate where we all meet up, and there's going to be world-class speakers. We're going to get people, and we're actually going to implement your plan. And there's loads of different bonuses. We're going to have a card game tournament where essentially the winner will be the world champion of the card game that we've created. So the silver package is the card game. It's the training. It's going to be 90 minutes of training, which teaches you how to invest in 90 minutes. I've also got 4 hours of bonus material that's teaching you how to invest. You have a life plan, you have weekly strategy sessions, and you have access to the best investing platform. So we don't invest your money. We partner with the best FCA regulated investing platforms, and we teach you how to invest your money. So then bronze service, check out the podcast, Millennial Money Mindset, check out the YouTube channel, Millennial Money Mindset, pick up the book on Amazon. You get it for around £10. It's also in Walmart, it's in Blackwater, is it? Or Blackstone, the bookshop, and it's also on Amazon. So get it in Kindle version, get it in print, or get it on Audible version. Listen while you're on the bus or listen while you're cooking. So that has been how to, and also before we go, make sure if you want to pick up your free gift, I should send you that training over. Just send me a yes in the comments. Hopefully that's been helpful. Please like, please subscribe. We've gone over the 7 ways to reduce your risk, reducing investing risk. My name is Neil Doig. This has been Millennial Money Mindset. If you want the fruits, you need the roots. Please like, please subscribe, and please tell a friend about this channel. Thank you so much, and hopefully hear from you soon. So as I said, please like, please subscribe, and please tell a friend. Take care.